Welcome back, everyone. We have an exciting episode to get into. I sold out of 70% of one of my 10 positions. This is a concentrated portfolio. Almost all of my money is in just a handful of companies, and one of these positions I sold out of 70% of the position. Now, I won't leave you hanging for long. I'll just go into it. It's Salesforce. I decided to reduce my stake in Salesforce from a little over 6,000 to now 2,000. And I want to go over some analysis and the reason why I did that, because there's been some changes in Salesforce, the stock, that I want to point out. As well as, I want to just do a portfolio review. The Story Fund has had a phenomenal year this year. It's really recovered. We're almost in the green. And at one point, this portfolio was $40,000 in the red. Now it's 14,000. So we've made back a ton of ground. It's really had a good year. And some of these companies that were out of favor just 6 months ago have really gone on a run. So I want to go over them. I want to go over the valuation and some news regarding my biggest positions like Amazon, Netflix, Google, and Microsoft. So having said that, we have a lot to get into. Let's go ahead and start right off. The first thing that I want to mention, and this is something that I think is important to highlight because I still believe that this is something unique that we do in this channel. Most commentators, financial analysts, most personalities on Twitter and YouTube that talk about finance do not show their performance. They don't show it. I watch a lot of them. I look at a lot of them that do it. And even the ones that do show their performance, they don't show it in totality, meaning they don't show their total returns. They just show how some holdings here or some holdings here are doing. So what we do on this show is different. It's unique. I show my portfolios and their total return since the very beginning. And then I even track this in a time-weighted way as well, which we'll be looking at in just a minute. So we have the Story Fund here. This is the smaller of two of my portfolios. So if I go over to the passive income portfolio, many of you have seen this one. It's my main one. This one is more focused around really high cash flow, organic growing compounder companies. This one's been it's performed really well. Over the past 2 years, it's done really well. I'm happy with the performance of this one. I've had really no issues with it. There's been no tragic instances of companies just doing terribly. This one's been going along quite nicely. Then we have the Story Fund. This one I started in 2021. And I started it as a tech portfolio. That was the wrong time to start a tech portfolio. So when I started this one, it had a massive sell-off. And even when I was adding money to the portfolio, the value was dropping because tech companies were just getting crushed. And we know the story, the Fed raising interest rates, causing the valuation of multiples of these companies to come down. And that was a very unfortunate time for this type of investing. Now, luckily, I mostly focused my money into very good companies that have very sustainable moats, sustainable business models, and ones that I thought would come out the other side stronger, even after all this craziness in 2021 and in 2022. And that's largely happened. There has been a pretty big recovery. So let's go ahead and take a look at the time-weighted returns. This is a spreadsheet that I keep track of, where I put in every single buy and sell. And then I create a alternative universe as if I had put this money in the S&P 500. This is what it looks like right now. The blue line is the Story Fund, my portfolio, and the performance of it every single time I've updated this. And then we have the S&P 500 in red. So again, this is as if I put the same amount of money in each of these portfolios at the exact same time. So it's as fair of a comparison as you get. What we can see is right here at the end of 2021, when all the tech companies started to go down, mine got sucked down with it. A lot of my portfolio sold off. Now, I will say that I'm not just blaming the market here. I made some critical errors as well. One of the biggest errors I made during this time period was I purchased a company called Alibaba, which is a Chinese retailer and e-commerce cloud computing fintech company. I had done a lot of research on it. I'd read articles on Morningstar, Seeking Alpha, lots of investment blogs. I read about the company in many ways that I could, but the company performed terribly. It did not perform up to my expectations. And I would also say that I was influenced by Charlie Munger as well, legendary investor that bought into Alibaba. And he was very confident on it as well. And I'm sure that influenced me as well. That was a big mistake. I should have avoided Alibaba because most of the research I was doing was completely second and third hand. It wasn't one-on-one research, and I had no direct, there's nothing I could do directly with the company like I can with Netflix, like I can with Intuit or Amazon or any of the companies that I own. So that impacted the performance very negatively in 2022. And then the other thing right here that impacted it super negatively was Netflix. Netflix had 2 consecutive quarters of missing their subscriber estimates, but not only missing them, their subscribers went negative. So they lost subscribers for 2 quarters in a row, causing the stock to drop over 50% in total. Now, this was a man overboard event. It was a cataclysmic hit to the company. The stock price down over 50%, and I had decisions to make during this time period. The decision that other investors made, many of them, like Bill Ackman, was to sell out of the company. The thesis changed. It was too unpredictable. Time to move on. I still felt that Netflix was more predictable than the stock price showed, because even though they lost subscribers for 2 quarters in a row, 6 months, the amount that they lost was only 500,000 and then 1.2 million. They have over 220 million subscribers. So losing 1 million is losing less than 1% of their subscriber base. It's barely a fraction, right? It's like 0.5%. So I didn't think it was as big of a deal as the market. And I continued to buy Netflix throughout this entire period. For the whole year, I continued to add to the position at a lower price. And that turned out to be a very, very good buy. Netflix has gone up over 100% since the lows, and that's largely recovered. Other stocks have been struggling as well. We have one of my top holdings here, Amazon. In fact, this is the top holding by far, which this is another one that had a cataclysmic event. Amazon stock went down around 50% from its highs, causing my performance to do really poorly. Now, Amazon's another company that I'm just thinking the whole time it's selling off, that this is not the story over for Amazon. Amazon is growing like crazy. They're growing in ads. They're growing AWS. They're growing their operating income. And the reason they're going down is because their free cash flow is so heavily impacted by the fact that they're doing so many major investments. So that was another thing that impacted the performance of this portfolio very negatively throughout 2021 and 2022. But then we get into 2023. The market in 2023, almost on a dime. This is the beginning of 2023. And look at what happened. The market on a dime decided to change its opinion on tech companies. And I think a lot of this has to do with macroeconomics and the fact that inflation's coming down. But for whatever reason, investors are now way more bullish on tech companies. So we look at it from 2023, and my portfolio is almost on a straight line upwards. Okay? Just racing upwards. I look at the companies, and I can filter by year to date, 2023. Look at this. We are in the green 32.2% in 2023. 32%. That's $33,000 we made back up just this year. So this is why I say, even though right here it didn't feel good, and I felt, it's just sad. It's kind of embarrassing. You're on YouTube showing your portfolio and it's not doing well. I still thought there's a good chance that we'll have a good rebound with these companies because investors are not giving them a good bid. But now they are. 2023, we're getting a bid on these companies. And companies' stock prices are going up, especially growth ones. So what we have here is this year, a lot of companies that I own going way up. And when that happens, I like to look at if anything is getting a little bit ahead of itself. Now, to track this, I have a website that I developed called Qualtrim. If you haven't tried this out, I recommend you do. I think you'll love it. I offer a free 1-month trial where you literally don't pay anything up front because I am so convinced that you'll love it if you try it out. But regardless, let's go ahead and take a look at this. What we have here is a watch list page right here. And I can go and look at all my companies. So we have my companies off to the left here. This is a global watch list. If I go into the story fund right here. So this is the story fund, every holding in it. And let me look at this. We blow up what we call here the dip finder. This is something that I developed a while back, which is not anything too special, but it basically shows you how all of your companies are trading. So you can see which ones are in a dip or you can see which ones are in a price surge. And this helps inform investors on how all of your companies are trading at a glance visually. Now let me filter this by the year to date to give you a visual illustration of how my portfolio is trading. This is what it looks like. So off to the left here, we have Adobe. Adobe's up 10% year to date. Not great. It's actually right there with the S&P 500. And Adobe's a tech company. So Adobe's underperforming its relative pairs. Then we have Pool. Pool's up 15% year to date. We have Netflix. Netflix has had a pretty staggering rebound, up 25% year to date. Then we have Amazon up 34% year to date. Then we have Microsoft up 35% year to date. Huge comeback on that one. Apple's up a staggering 40% year to date. Google's up 40.4%. But then we have Salesforce. Salesforce is up 57% year to date. 57% in only a few months. So this one it's just drawn my attention. When I look at these charts and I see how much Salesforce has traded back up, it catches my eye. So I'm looking at this thinking that Salesforce has done uniquely well year to date, up 60%. That is insane performance from this company in a short amount of time. And that makes me cautious. It makes me cautious when a company trades up this fast, this quick, that it may be getting ahead of itself in terms of valuation. So from here, we can look at the valuation of the company. Let's go ahead and look at Salesforce. I can type it in here, and we bring up Salesforce right here. So this is Insights. This is a feature that shows you all the fundamentals of the company, the balance sheet, the earnings, the net income, the cash flows, and the price. And again, we can see 60% just year to date. Now we're looking at Salesforce here, and we have the company at $212. It's up another almost 1% today. So the company's still on a roll. It still has a lot of momentum. But when I'm looking at this company, I'm also paying attention to the valuation of it. It just went up 60%, and the valuation has obviously probably expanded. It's probably become a lot more expensive over that time period. When I look at it, there's two ways to value companies, in my opinion. And one of them is through the PE ratio, through earnings. And through the earnings, the company is not that expensive on a forward-looking basis. It's trading at a 24 forward PE ratio. 24 forward PE for a tech company, that's not too bad. But this is the problem I have with earnings. In many cases, the earnings looking forward are non-GAAP earnings where they adjust out different things, like the expense of stock-based comp. They take that out of the earnings, so it's as if they're not paying their employees, and the earnings are after that. So the PE ratio on a forward basis with some of these companies is heavily manipulated with these non-GAAP adjustments, and the analysts use that, and that's where you get the 24 forward PE ratio. That's why in many cases, the trailing PE, which is GAAP, is much higher. So that's where you see these discrepancies there. Now, because there's so many different ways to game the PE ratio, I've also started to look really intently on the cash flows of the company. There are ways to try to manipulate cash flows, but not as many. And in my opinion, the cash flows of the company are much better indicators of the actual valuation because it's harder for management to come up with ways to try to game the cash flow, to try to manipulate the cash flow. So looking at the cash flow valuation of the company, we have the free cash flow yield. For those of you that don't know what the free cash flow yield is, it's the yield of the free cash flow. So just like the dividend yield is the yield of the dividend that you're getting, this is the same thing, the same calculation, except for the free cash flow. So for example, if a company has a market cap of $100 billion and they made $3 billion in cash flow last year, then their free cash flow yield is 3%, 3 out of 100. Very simple calculation. And that is exactly the case of Salesforce. Salesforce is a market cap of $205 billion, and the company made around $6 billion in cash flow last year. In fact, we can check this for ourselves. This is the trailing metrics, but we have right here $6.31 billion. So $6 billion in cash flow, a company that's $200 billion market cap, we have a free cash flow yield of 3.03%. And on this metric alone, Salesforce seems like it's at a completely reasonable valuation. In fact, it seems decent. 3% free cash flow yield for a company like Salesforce seems like a good bet. The problem is, again, these adjustments these companies make. I've been talking about stock-based compensation for a long period of time. But what I decided to do is add into Qualtrim another valuation metric, which is the stock-based compensation adjusted free cash flow yield, meaning that we're actually bringing back stock-based comp. We're factoring that in as an expense, not as something that just doesn't exist, and then we're calculating the yield after that impact. And when you factor in stock-based compensation, the free cash flow yield drops from 3.03% to 1.45%. The impact of the stock-based compensation is 51.94%. 52% impact. That is substantial. So suddenly, Salesforce just got twice as expensive when you actually add in the expense of stock-based compensation. So when I look at this, to illustrate this visually, we pull up the chart here. This is Salesforce growing its free cash flows at a very fast pace every single year. But then we add in the stock-based compensation. On a trailing basis, Salesforce's stock-based compensation, this line in purple, is 52% of the company's free cash flow, which is the lines in orange. So it eats up nearly half of their free cash flow. Now, there's some people that argue this shouldn't be added in. Stock-based comp is different than cash flows because it's not cash. But it's basically the same thing. When you pay an employee with stock or you're paying them with cash, they are equivalent value. It's like a payment in kind. It's as if I either paid you in a Visa gift card or I paid you in cash. They're both worth the same thing, even though one of them, a Visa gift card, is technically not cash. So that's how we look at it with stock-based comp. I'm treating it as if it was an expense, just like cash, which you should treat it as. And when I do that, I find that the company is no longer at a valuation that I think has a ton of upside. Now, I don't think that Salesforce is dramatically overvalued per se. That's why I'm keeping a little bit in the stock, but I just don't see nearly as much upside. If the company ran up again another 100%, the actual free cash flows would be 0.75%. They'd be incredibly low. So I could see Salesforce running up a little bit more, but the valuation is getting more and more stretched. When I look at it relative to other opportunities in my portfolio, I think there's better opportunities. So after seeing this massive run up in Salesforce, it going up 60% year to date, and after seeing the true yield of the company, the true yield after factoring in stock-based comp, I decided to sell the majority of the position. I sold $4,000 of it, and then I put that money into 3 different positions here. $2,000 into Google, $1,000 into Amazon, and $1,000 into Netflix. And I want to go through all of these companies and explain the valuations of some of the companies in my portfolio. We'll go ahead and start off with Google. This is the one that I put the majority of my money into from the sale. So the majority of it went out of Salesforce and into Google. Let's go ahead and take a look at this. So we bring up Google here, and this is a company that I've said repeatedly for the past year that I think Google is plainly undervalued. And a lot of times people think, well, Google's a big company, it has a big market cap, there's lots of analysts covering it, so how could it be undervalued? Wouldn't they be valuing it correctly? Big companies like this are frequently not trading at their intrinsic value, and Google hasn't been trading at its intrinsic value for a long period of time. Let's go ahead and take a look at the same type of valuation metrics for Google. This company has a lower PE ratio than Salesforce, so instead of a 23, its PE ratio is a 17.8. Now, if we compare that against the S&P 500, the S&P 500's PE ratio is about 16. So you're paying slightly more for Google than the S&P 500. Slightly more for this company. I think Google, in terms of qualitative aspects about the company, its moat, its competitive dynamics, its profitability, I think it's much better than the average company in the S&P 500. So I say right there, even based on the PE ratio, that if I was to compare it directly against the S&P 500, I think it's a much better deal. Now, we look at the cash flows. And again, this is where we get down to the bottom of the true profitability of a company, how much cash it's producing every single year. 2.6% free cash flow yield, even factoring in their enormous stock-based compensation. And the impact of the stock-based compensation on Google's free cash flow is minus 32%. But even after chunking away at a third of the free cash flow, it's still at a decent valuation. 2.6% is not bad in my opinion for a company like this. Again, Salesforce was at 1.5%. So Salesforce's was incredibly low and stock-based comp was 50%. So Google's trading at a lower PE ratio and a higher free cash flow yield, which means the company overall right now is cheaper than Salesforce. The only other thing left out of the equation is the growth of the company. Salesforce is growing at a steady pace, but I think that Google will continue to grow its free cash flow every single year. So when I look at Google, I know this is another company that's run up a lot this year. It's up 40%, which does draw my attention. The company's done really good so far, But even after looking at the recent run-up, when I look at the absolute valuation metrics and I compare these against the alternative, which is the S&P 500 and treasuries, I still think it's attractive. 2.6% adjusted free cash flow yield with a company that's growing its free cash flow steadily every single year. A PE ratio of 18, I think is very comparable to the S&P 500. So I believe that Google still has more to run. I could easily see the stock going to 150. At that point, I might look at putting my money elsewhere. But right now, I still think it's in good shape here. So I've sold some Salesforce, bought more Google. I also bought a little bit more Netflix. Now, I want to take a look at Netflix here in my holdings page because this has been often cited, often quoted by critics of mine, that this is my worst buy ever, that Netflix was the worst position, worst thing I've ever done in investing. This is what the Netflix position looks like right now. Netflix is currently down 14%. That is it, 14.9%, so 15% total. So my worst buy ever, my worst position ever, according to my critics, is a company that I'm down 15% right now, which in my opinion, I don't think is too bad. Now, I'm down around $5,600, and at one point, this company was doing a lot worse, at least by the stock price. Now, one thing I want to mention is the most difficult part about the Netflix holding so far. To give you an inside look at the psychology behind it and what I was thinking during this time period, the most difficult part by far was keeping my cool during this huge sell-off. The stock fell down like 20% or 30% in a single day, and then it continued to tumble. And this is one Bill Ackman bought into the stock. He bought in right here. And then it fell another 30% down to here. And that's when Bill Ackman sold out of the stock. So he bought in, 3 months later, he sold out of the company. But here I am, still holding the company, and I bought in right here and right here. And the psychological aspect of that, trying to keep a level head and keeping your cool while being a little bit of a public figure, I have a lot of eyes on me watching me buy into this company, that's difficult to do. There's a lot of criticism, a lot of difficulty during this time period. So keeping a level head and staying calm during this time period was one of the best things I did for my portfolio. And buying during this time period really helped out the returns of this portfolio. Now, if we go into it, the reason that I still am bullish on Netflix and the reason that I continue to buy the company is I still think that the market doesn't get Netflix. I still think there's a huge discrepancy between the core fundamentals of the business and what type of position they're in, the huge network effects, and the operating leverage of the business. I think that Netflix will have huge operating leverage. When we look at the company right now, it has a similar adjusted free cash flow yield as Salesforce, right around 1.5%. Now, it doesn't have as much stock-based comp. That's something that they're much less than Salesforce, but the yield of the company is equally low. So why am I buying Netflix instead of Salesforce? Well, Salesforce is growing its free cash flow anywhere from 15%, maybe up to 20%. Netflix, on the other hand, is growing its free cash flow at a much, much greater speed. Let's go ahead and look at this over just the past couple of years. Netflix grew its free cash flow from 2015 being minus $3 billion to 2022 being 1.6 billion. Minus 3 to 1.6 in 4 years. That is massive free cash flow growth. They are projected this year to grow their free cash flow by $3 billion. So it's going to go from 1.6 and then it's going to double this year. Meaning that this trailing free cash flow yield of 1.5, if we were to adjust that and say we're going to look at this year, it would be a 3% yield, not 1.5. So the yield is already double what it looks like right now. $3 billion, in my opinion, is going to be on the low end. I have a prediction that I think that Netflix is going to come above $3 billion in free cash flow this year. I think they'll do it. And then on a 5-year basis, I think the operating leverage will continue. Netflix is in such an advantageous position when it comes to the streaming industry. Paramount Global, they do not have the reach. They don't have it. They have Yellowstone, and they're being taken advantage of by the grift of the Yellowstone creator. He really is taking advantage of Paramount's production team by charging them exorbitant amounts to run this show. You have Disney, which is both increasing prices and cutting back on their content costs. They've basically decided to give up trying to catch up to Netflix. You have the big tech players, which are always a factor, but they're not hampering Netflix in any way. And then you have Netflix, which is highly free cash flow positive, has immense operating leverage. So in terms of the free cash flow yield and the valuation of the company, I still think Netflix is cheap. And I know it's crazy saying that because it was a lot cheaper just a year ago. But I'm looking at what I think is going to happen with this company. I think we're going to see the company above $500 again. Now, finally, we get to Amazon. This is another company that I just added slightly to my position. Amazon may have the ugliest looking free cash flow profile currently that I've ever seen in a company, ever in the history of any company I've ever looked at. It is truly awful right now. Let me just give you a look at it. We'll look at some of the numbers here and we'll see this crime scene of a free cash flow profile. And yes, these numbers are correct. They're not typos. They're not miscalculations. We have the cash flows right here. The simple free cash flow yield, which is typically the good looking one, is not good. It's minus 0.74%, negative 0.74%. Then we have the stock-based compensation adjusted free cash flow yield, and that's negative 2.55%. Now, if we flip that around and inverted it and made it a positive number, then it would be okay. It still wouldn't be great, but that would at least be a decent yield for a company like Amazon that's growing. But it's minus 2.55%. So if you look at the two numbers going from one to the other, 246%. So let's go ahead and take a visual look at those numbers. Another way that I would illustrate this is right now, Amazon basically has the stock-based compensation of Google. We can look at their free cash flow profile. They have $20 billion in stock-based comp, almost identical to Amazon, but Google has $60 billion in free cash flow. That's the difference there. The reason that investors are okay paying this stock-based comp is because Google's producing $60 billion of free cash flow. So the stock-based comp is only 30%. We go back to Amazon. They have the same expense as Google, the same $20 billion in stock-based comp, but then their free cash flow was minus $17 billion in 2022. So we see the problem there. Currently, based on trailing metrics, Amazon has an atrocious free cash flow profile. It just looks awful, and they have a lot of work to do to fix it. But there is a silver lining to this company, and I still believe that Amazon is going to be a really good stock in the future. If we look at the actual metrics here, this is a table I got from James Boltard off of Twitter. This shows the position Amazon was in before the huge retail spike in 2020, and then where it is in 2023. We look at the first party sales. This went from 36.6 billion to 51 billion. We have third party. This is the higher margin part of the Amazon online retail business. This went from 14.4 billion to 29 billion, over doubling since 2020. We have subscriptions. Everybody likes this, very high margin, 5.5 to 9.6 billion. It's growing steadily. Then we have the ads segment right here. This went from 3.36 billion to 9.51 billion. Ads tripled over this time period. Massive increase in their services. When we look at the stock price here, Amazon really has not moved at all since Q1 of 2020. That was right here. The stock price is right around the same. This happens all the time in the stock market. Buffett continually referred to it as a weighing machine. In the long term, it's a weighing machine. In the short term, it is a voting machine. Right now, you're seeing the votes up and down from stock market participants, but over time, the true cash flows, the weighing machine will come into play. I believe that Amazon is winding down their logistic investments. They're winding that down. It's going to take some time, but when they do, their cash flows are going to explode. That's my thesis on the company. I think that this orange bar is going to explode upwards to be 40, 50, 60, 70 billion dollars. When that happens, I think that you'll see investors clamor to the stock, pile in on it like they do every time that a company suddenly has a huge swing in profitability. And if that does happen, because of how big this position is, it's such a large, meaningful position to this portfolio, it will make it so that my portfolio surpasses the S&P 500. So part of me beating SPY is Amazon doing really well and actually generating free cash flow and getting investors back on their side. That's part of me outperforming the S&P 500. If Amazon can't do it, if they can never get costs under control, if they continually just spend, and their cash flows continually look horrible, then I won't beat the S&P 500, or at least not likely. So part of it is dependent on Amazon, a key position doing well, and only time will tell. But that is the update for today. I hope you enjoyed. Let me know what you think. And if you want to try out Qualtrim, You can try it out for free as part of the Patreon membership. No strings attached. Go ahead and try it out. I think you'll love it.